Welcome everyone to MHA's 2025 budget video. I'm joined here by three of our senior tax partners. The budget was trailed around providing a cut in the deficit, a cut in the cost of living, and a cut in NHS waiting lists. Initially, the Chancellor talked about growth, which is exactly what the country needs. The forecast for 2025 has gone up. However, the forecast for the following years has gone down, leading to reduced tax revenues and a few more challenges for the government. They did announce some key measures after the OBR beat them to it. But going to our specialists now, what was the key highlight for you, James?
Probably several things I'd mention. I mean, from a private client perspective is kind of my focus. There are things we knew were going to happen, and there was a few surprises. Now, we knew, didn't we, that they were going to freeze income tax and NIC thresholds for a further 3 years now, from April 2028 through to 2031. That means the thresholds would have been frozen for a whole decade by the time we get to 2031. That has a material impact on a certain demographic within the population. I looked yesterday at some numbers of someone who perhaps earned around 50,000. That's right on the higher rate threshold in 2021. Their effective tax rate jumps by more than 3% over that 10-year period, assuming that their income grows in line with average inflation. Final point on that is that there must be simpler ways of dealing with this. You know, the tax system is unnecessarily complex. It's kind of the middle of the population, the sort of middle England, if you like. That's perhaps not the right phrase. That takes the brunt of changes like this. Actually, far simpler. Add a penny on income tax. It's the people it's the higher earners will pay proportionately more. Whereas with a freeze in thresholds, actually, those at the upper end aren't paying any more tax at all.
Thanks, James. And Robin, from a VAT and indirect tax perspective, what was your highlight?
I think the main thing is the things that didn't actually happen in the world of VAT, but what did was be more in the customs duty space, which was the scrapping of the low value import relief. So this is currently where imports below £135 and coming without customs duty. As we've seen the rise of the likes of Shein and Temu, those values of low value imports have tripled over the last few years. So it wasn't really a surprise to see them scrapping that low value import. We've seen the same in the US. Europe are doing the same. So that's going from, March 2029 at the latest. But there's still lots of questions about how it's actually going to work. There's talk of a bucketing system where lots of imports will be put together to get rather than having to do the customs duty on each individual item. But also what it's going to be looking to do is those overseas importers are now going to have to, one way or the other, register in the UK to account for that or point a fiscal rep. So there's going to be a big impact on those businesses, how they actually adapt and how their business models adapt. But ultimately, as always, it will be the consumer ends up paying more.
And it seems a good policy to support retail in the current climate. However, if I'm a retail leader, I'm saying, why is it taking 4 years for you to help us? We need help now off the back of the price rises in staff costs that they've experienced off the last budget.
Absolutely, and it's been something that's heavily been called for from domestic businesses, because it's really putting the retails, the high street retailer, under pressure, all those low value imports. But yeah, it's taken a while to come in because it's the complexities and the lack of clarity on how it's going to work.
Interesting. Richard, from an employment tax perspective, what was your highlight?
Definitely the main headline, Chris, was obviously the much heralded cap on national insurance relief on pension salary sacrifice. So this new cap from April 2029 of £2,000. So anything above that, if it is delivered via salary sacrifice, those pension contributions would attract national insurance. So a big change from where we are now, with people, many people sacrificing a lot more than £2,000, and having that limit, that future limit, is going to really, I think, also restrict the ability of employers to deliver attractive benefit in kind schemes, overall sort of remuneration packages, because pension salary sacrifice for a long time has been a real core of those reward packages for many, many employers. If you think back to 2017, when HMRC last did a huge overhaul to the rules on salary sacrifice, they really limited down the number of benefits that were compatible with salary sacrifice, and pension was always a key one. Now that they survived those changes, and have been, heavily used by employers since that time, since 2017. And so to change that is a massive impact on benefit and reward strategies that employers are going to have to get ready for in time for April 2029.
And it seems quite short-termist, isn't it? When what you hear is encouraging people to save for their pension is absolutely what's needed. And so the short-term tax take, but potentially jeopardising the long term.
That's it. Yes, I mean we've all read the coverage about the pensions crisis in the UK. Not people not saving enough for retirement. I can only think this is going to sort of limit retirement pots, in a way that is not going to be beneficial.
Exactly. And in my area of corporation tax, there was heavily trailed that there were some adjustments to capital allowances that raised £1.5 billion. However, what was not largely publicised was that's just a timing difference. That just means extra tax paid in the next few years that won't be paid in the future. So again, a short-termist solution rather than anything significantly material there. So James, a lot more in your area. Any other points you'd like to share with the audience?
There are a few surprises, I suppose. Firstly, the increase in income tax rates on unearned income or certain unearned income over the next few years. So from April 2026, there'll be 2% on all income tax dividend rates. And from April 2027, the savings rate of income tax will increase by 2% at all bands, and the same for property income. The odd thing here is that the particularly for the property and savings income rates, they're not coming in until April 2027. That won't be really felt until the 2027-28 tax year. Tax payments January 2029, right ahead of the potential election. Do they really want significant income tax increases ahead of the next election? So that feels a bit odd to me. Perhaps more welcome news for private clients and business owners is the slight tweak to the agricultural and business property relief rules. Going forward from April 2026, the first £1 million of value of business or agricultural property will qualify for 100% relief from inheritance tax. And that £1 million allowance wasn't originally going to be transferable between spouses, basically meaning spouses are going to have to jump through hoops to get the 2 million of allowance between them. Now that allowance is going to be transferable in the same way as or a similar way as the normal inheritance tax nil rate band is. So that is a welcome simplification measure. Another point is they widened the scope of venture capital trusts and enterprise investment schemes. They're sort of tax-favoured investments, so where the tax system incentivizes people to make investments. But whilst they've widened the scope of those investments from April next year, for venture capital trusts, the income tax relief available is reducing from 30% to 20%. And can't remember exactly when, but originally that was 40%. So that's come down significantly, probably encouraging people to make investments, or certainly I'll be encouraging people to look at investments this side of 5th of April 2026.
Excellent. Yeah, I think the key conclusions were around, having a sustainable tax system. But if we look at the last circa 20 years, GDP's gone up by about 35-40% in that time, whereas the tax receipts that the government benefits from have pretty much doubled in that time. So there's a lot of people are feeling a bit overly taxed. So we loved the comments around growth at the beginning of the Chancellor's speech, but by the end it just felt a little bit like a lot of tinkering going on. Thank you all for watching. Thank you, James. Thank you, Robin. Thank you, Richard. If you need any advice regarding any of the comments that came out yesterday or any of the areas that impact you, please don't hesitate to reach out to one of our colleagues at MHA.